Welcome to Corporate Venturing Insider, a show about the people shaping the future of innovation, one investment at a time. I'm Nicolas Sauvage. Every 2 weeks, I sit down with leaders from across the corporate venture ecosystem to explore how they support entrepreneurs and the best practices they've learned along the way. Today, I am joined by Temple Fennell, co-founder and managing partner at Clean Energy Ventures. Temple, could you begin by explaining how you began your journey?
Certainly. Well, my first exposure to venture capital was really in the 90s. I was an engineer by training, systems engineer, and we patented a technology with a couple other people. It was an internet technology. It was actually for online services and internet back in the 90s, and basically built one company around that. And we launched a second company too. So first one was a online game show platform. Back in the day, people were connecting at a 2400 baud modem with a 286 PC. And how do you create fair gameplay with somebody who's maybe connecting through MIT with a PC simulator and broadband? And we figured out how to do that. And then we also launched an online education company with a couple of really great partners. That was it was initially CD based, and then we moved it to online. And more than 20 years ago, I ended up marrying into an oil and gas family. So my wife's family's from Louisiana, Texas, Arkansas. So it's a traditional sort of timber, oil and gas, large scale agriculture family. And we started investing in clean energy and in regenerative ag back in 2007. And one of the ways we got into clean energy is the CFO of one of my businesses resigned in 1999 to be a wind developer. And just being in touch with him and learning a little bit about the wind space through him, when we actually decided, okay, we want to put a certain amount of capital into this clean energy space. Of course, we looked closely at Coastland Kleiner and NEA, and the folks that I knew pretty well. And quite frankly, I didn't quite understand what they were doing. I loved the technologies, I loved the team, but I couldn't understand who was actually gonna be the customers of these technologies, number 1, and who was gonna actually buy the companies, once they were actually built. And from what I could see, their customers had to be utilities, and from my perspective, these technologies would make utilities, would help them make their assets more efficient, which is pretty much the last thing a utility wanted to do back then. They got paid to build more assets, not to make existing assets more efficient. Oil and gas, back in that time, oil was $120 a barrel. Everybody was spending every dime they could to discover more oil. And even though there were algae farms and biofuels and things like that, other than ethanol, I really just couldn't see how this was a venture play. So given that I had, this friend, who was my CFO who knew a lot about the wind, he proposed an idea of essentially having a long-term view around acquiring wind rights, because the wind development was entirely based on production tax credit back then. And every time and the PDC was in this cycle of expiration and renewal, and every time it would expire, the wind developers would effectively struggle to raise money, and everybody would write, wind is not a viable industry. It had to be subsidized to these PDCs. But we took a contrarian view and said, we don't believe this. We believe the technology and the cost curve is coming down. We believe that it is going to be ultimately viable at one point. It's not going to be 3 to 5 years. It's probably going to be 10 to 15. So we made a bet with this guy, Sandy Reisky, and creation of Apex Clean Wind and Greenlight. And that company did very well. But so I really kind of got in the clean energy space through my project finance background. So really kind of started much more downstream. But as I got more just my engineering curiosity, I really wanted to understand the technology. And then about that time too, about 2010, 11, 12, we also started seeing a number of families like ours that were investing in ag tech and clean tech and even some water tech. And we came together and we created a syndicate called the CREO Syndicate. CREO stands for Clean Renewable Environment Opportunities. We are primarily investing quite privately in these companies, and that network has actually grown quite a bit. It's now about 230 families, I think, globally, close to $1 trillion in private wealth. Extremely active investing, probably the most active group in the world. So I picked clean tech, and I realized that, the more I knew about clean tech and clean tech technologies, the more I realized I didn't know. And that I really, if I wanted to do this well, and I didn't want to just be a dilettante, I really needed to go back to school. So I applied to be a fellow at the Sloan School at MIT and came up and just went really deep into the MIT technologies in the ecosystem. And that was tremendous for me to really kind of really understand, all the different parts of what I was interested in with regards to clean energy technologies, and ultimately really became primarily interested in industrial decarbonization. What does it take to take technologies and help these large corporations decarbonize? And ended up kept hearing about this group in Cambridge in Boston called the Clean Energy Venture Group. And so I ended up meeting Dan and Dave, became a member of Clean Energy Venture Group, and really kind of got into their portfolio. And at that point, I think I was the 18th member. They started in 2005. This is now 2015. And what was remarkable that I was seeing in this portfolio is they had this incredible low loss ratio. They had only of even though they were doing hard tech, they were doing advanced materials and electronics and hardware, and they was all early stage. They'd only written off about 15% of the portfolio. That was now probably 35-40% of the companies. And so, of course, for me, I was like, how is it that these guys, this is again 2015, Coastline Kleiner, and we know what happened in the clean tech 1.0. But I was curious, was like, how did these guys' portfolio not only survive that time, how did it thrive? And they'd actually formed a number of SPVs. They had a sort of a portfolio of single purpose vehicles they created that were part of that. A number of family offices and investors had come to them and said, how you guys are so successful, how can we invest alongside you? So they put together these SPVs, and when I ran the IRR, it was extraordinary. And they had high DPI, they had high IRR, virtually unheard of. And so I started socializing that with some of the families that were in the CREO network, and also with people that I knew at Cambridge Associates. And they were like, "Wow, how do we get behind these guys? I mean, this is really a phenomenal track record and really deep technical team." So CEVG is really there are two types of folks that are in that group. One of that are, engineers and operators like myself that have built and scaled businesses, and the other are people that are coming from the industry. So people that were senior executives at Siemens or GE or United Technology Corporation. So I started telling Cambridge about it, as well as talking about the track record, and also some of the families in the CREO Syndicate. And what came out of that was, looking at this, and at this point, I was back at the family. I took a sabbatical from the family office board, from the investment committee. It's back, working with the family. And I worked with Dan and Dave, who were two of the founders of CEVG and my partners now, to really kind of structure it was initially going to be a $50 million fund, and primarily almost exclusively financed by the CREO Syndicate families, who wanted to have access to this team, and the team wanted access to the capital. And we went to do a first close. We ended up having about $70 million in commitments. And when LP, said, if you guys would be willing to increase the size of the fund to 100 million, we'd fund up to 40% of that. So at that point, we actually stopped raising capital. I basically resigned I think I was maybe even at Flagship Pioneering at that point as a full-time consultant, but unwound some of my obligations, because some of the family said, "Would you be the third partner in this fund, CEV, that we launched?" And so we opened it back up, blew through the $100 million cap, and stopped taking capital at about 110 million. So it was not I had on the VC side, I'd spent most of my life either receiving capital from VCs or providing capital to VCs. I hadn't been a GP until I joined CEV.
Thank you, Temple. I think there is so much to unpack, but I think one golden nugget you mentioned, which I don't need to double click, is ag tech and clean tech are so different. Even in our own investment practice, Tina is driving the clean tech and Ravi is driving the ag tech. It's just so different. You need to really have different convictions.
Yeah.
So, before we talk about your experience of receiving capital or giving capital, I think something that comes across is your curiosity, building from first principles or investing from first principle. I think it all comes from your engineering background. Can you speak to why you think so or not that your engineering background drives you as a better investor?
Boy, yeah, I mean, I would say I have a natural curiosity, as you mentioned, and a bit of sort of dogged persistence and stubbornness. We have a brilliant team, and I would say, most technologies that come across our transom are first of a kind technologies that or technologies that don't exist in the market. Companies like Macrocycle, it's a chemical recycling companies like Nitrofix that's basically able to create NH3 molecule, eliminate the NH3 molecule without using Haber-Bosch. So I don't understand those technologies when they come across. I have to have our chemical engineers, PhDs, and other people to really explain it to me. And I think the smartest question I can ask is after I've spent as much time as I can studying, and I still don't understand it. I'm happy to say to the founder and or my team, can you explain that to me again? And honestly, if you're asking a founder and you ask them, wait, what? And they explain it again, and you think hard about it, and you have to ask them more than 3 times, there's something wrong with this. Either they actually don't know what they're talking about, or they haven't really figured it out or followed through. And importantly, if they can't explain it to me after I've spent my time really understanding it with the help of my brilliant team, if they can't explain it to me, they're gonna probably have a very hard time convincing other people to give them money. They're not able to tell a good story. And that's a key talent, absolutely essential talent, an existential talent for founders to have is to be able to tell a good, simple story.
Yeah, I agree. It's existential talent because it's not just investors, it's the first few team members, it's going to be the customers, the partners. I mean, I think being comfortable, even disclosing to your team members what you don't know is so important. One is if you don't share, then you will be challenged because they don't know that you don't know. But two, it gives a chance for everyone to help you out where you don't know.
Yeah, yeah. Well, a big part of our assessment of, either bringing team members onto our team or CEOs, we talk a lot about what gives you energy, right? And we also then talk about what steals energy from you. And also, what are the things that you feel like you have to do that actually stop you in your tracks and you have a hard time getting started and you're willing to do it, but you don't love doing it. And so when we're building teams, we're very careful to assess what gives you energy. And that is often that person's superpower, right? They love doing it. And if you can get them to disclose what they're not very good at, which is probably one of the things that's stealing energy from them, you can say, we can find somebody that loves that they get energy from that.
So I think you just convinced me I'm going to change one or two questions when I interview team members because I'm going through the Kaufman Fellows program. And one of the big insight was around the zone of genius, which is basically what you just described, which is where do you get energy? Where do you get energized and you're really good at? This is a zone of genius. And this is what you should, as a VC, try to do as much as you can there because you're going to become excellent, build that superpower. But I never ask in the interview, where do you get energy? Where do you lose energy? And if you think about building the diversity of your team the right way, where people can compensate their superpowers and their weakness, that's a question I should be asking. So I'm already going to take an action from this interview.
That's great.
So, but let's talk about this. What do you think is your zone of genius? Something you're really good at that gets you a lot of energy?
It's actually ultimately a company builder. That's what I love doing, and I mean, because we are coming at the seed stage, and I'm the chair of 3 boards and on 2 to 3 other boards. I just love going in and working with the team. I mean, we have 2 of our companies right now are really at that inflection of scaling. They've got revenue, they've got purchase orders. We've brought them, through this. And, like, how do we take that to the next phase? I love that. I mean, I love building businesses. It's probably the thing that I love most.
Yeah, I can tell it actually. This is where you're really smiling when you explain it. So this is clearly something where it's not just gaining energy; you just love doing it. But let me shift to you mentioned strategic. So this is a good time to talk about corporate VCs. You work with them, you invest with them. I think you had mentioned before the podcast that probably 70% of your portfolio are in the cap table, they have a CVC. So, first, what's your view about CVCs? Do you think that most of them are good? Do they bring real value? Is it just talk?
Well, they're all quite different, right? I mean, as you know, and I don't want to necessarily throw anybody under the bus.
That's
Um,
not a good start of answering.
no, it's not. I mean, I would one of the big challenges I think corporates have, and not all of them, but we see this pretty often. We have in the last 20 years, is just there's a fair amount of attrition, right? Sometimes attrition at the very senior level of the CEO, and nobody likes to inherit somebody else's laundry, right? They don't like the hand-me-downs, and even if the CEO is the same, but you bring a different person in to manage the portfolio, they kinda wanna build their own portfolio. They don't wanna necessarily manage, something that they've inherited, so there can be a fickleness to CVCs on the cap table. The other thing too is sometimes the new person comes in and they start wanting to not necessarily play fair with everybody. They're feeling like they're the 800-pound gorilla and this company is beholden to them and they want information rights or they want exclusivities. When one of our roles, and it has been for the last 20 years, is what I say we sometimes play Switzerland between the entrepreneur that's like, oh my God, no, I don't want that corporate to know anything about what we do. They're our competitor. And the competitors are like, no, if we come in, we're gonna, we want to have an unfair advantage. And we have to say, first of all, work with the entrepreneurs and say, guys, listen, they're not your competitors. They're your partner and they might be your parent one day. But if you really want to scale this business, there is a lot that you can learn and a lot that you can take advantage of with this corporate. And we tell the corporates, if you want to see it at a table, there are certain rules of engagement about how you can actually have a seat at the table here.
I was going to ask about this because I've read your what you wrote, and you emphasize capital light models, and sometimes it's very difficult to reconcile infrastructure heavy demands with climate solutions. Can you speak to that a little bit?
So there's a set of criteria. We feel like there's a great book that I know the author, one of the authors of. It's called Simple Rules. And you create boundary rules, priority rules, stopping rules. And so we've been very clear since the beginning that we have certain boundary rules. Now, the boundary rules really it helps focus our team, right? So I'll give you a good example. When we were looking at green hydrogen, first of all, because we'd been in green hydrogen for so long, we were very dismissive of it. And so Jeff Weiss, who's our senior venture partner, he basically spent about a year and a half really understanding, okay, what would make green hydrogen investable for us? And he came back and said, you need to be able to produce a kilogram of hydrogen for less than 35 kilowatt hours per kilogram. Well, so that's great. So 9 out of 10 deals that are crossing our transom don't fit within that boundary, and our team doesn't have to spend any time on it.
Yep, very fast decision making. But I like boundary rules, so that's what we call KPIs in TDK Ventures.
Okay.
So boundary rules is clear. What's the next set of rules?
Well, start of priority rules, right? So you realize you have 5 deals, 10 deals that are all competing for your attention and you're having a really hard time. It tends to be a FIFO, first in, first out for the deals. And it really should not be, right? Because there's suddenly deals show up and it's like, wow, if we're not coming to a quick close because the technology is difficult to ascertain, we're struggling to really get the kind of data we need to run the market, you have to be willing to deprioritize that and reprioritize based on something that's just come in. And so that's really critical, because the whole premise around Simple Rules book is we have limited resources, time and people and money, and you need to be able to constantly reprioritize. The third is stopping, right? I mean, it's how you can just grind and grind away on a deal and you don't really have a clear idea like how to get to a yes or how to get to a no, but it's consuming resources by staying in the queue.
So this one I think is full of golden nuggets. So I mean we struggle with that ourselves. And it's not just for the first investment, it's also for the follow, double down or quit and so on. So What any best practices you can share about the stopping rules, things that you've seen working especially well?
Yeah, well, so there's two. You identify two different places, right, that you need to apply them. One is the initial investment. One of the things that we're doing is, we're constantly evaluating our IC, even though it's just me, Dan, and Dave. But I would say 75 to 80% of the companies, we either leaning hard one way or leaning hard the other. There are a few that we're sort of split, and that comes to the IC. But if we find we're constantly staying split, and there's really not a lot of enthusiasm. And no matter what we're doing, we really cannot get to an enthusiasm because it's in a limbo mode. We really need to have the discipline to develop a reason is what we would need to see in order to make the investment, communicate that to the VC and say, we're putting you effectively in a watch mode. And a watch mode means we want to actively stay engaged. Here are the 4 or 5 things that we need to change before we'll make an investment. And frankly, we put Macrocycle into a watch mode for a good year and a half, 2 years, and gave them 2 very specific things that they needed to solve for. And they solved for both of them.
So in a way, what you're saying is you have stopping rules and a restarting rule,
Exactly. Yeah.
which is good because then you allocate no resources until what you need to see, which actually is part of your boundary rules, kicks in.
That's great. I love that. That's really good. Another thing that we do, we write postmortems, like pre-postmortems, what went wrong, looking ahead 5 years.
So I think you're talking about pre-mortem, right?
The pre-mortem.
I think pre-mortem is such a good idea. It's tough to do, but it's basically listing everything that could go wrong. So maybe we'll touch on a touchy topic. How do you think about changing the CEO? Because at some point that might become obvious this is the best way for the project to succeed. How do you think about that?
Well, honestly, the best cases, we've had a number of cases like this, is the CEO's like, I don't want to do this job. We built the company to a certain point. I don't want to be on the road talking to investors. And so there's like, okay, great. And they often become the best recruiter for a new CEO. We go out and find a new CEO, but they're the ones who are really doing a spectacular job selling the business to the CEO. The other ones, though, and this is we're trying to get better at this. Honestly, I mean, just because many of us have been CEOs and have built businesses and have been moved out of the CEO role into some other role or moved up into the board or whatever, is to start with to lay out the track. As I was saying, you're maybe 100% internal initially and a little bit token investors, and then eventually you get to the point where it's spending 70, 80% of your time externally. You walk them through that journey. So how do you feel about that? I sometimes spend 40 to 60 nights a year on the road. Are you good with that? But you talk about that when they are just getting their first seed check and you lay out sort of the growth plan over the next 3 to 5 years.
That's an interesting way of framing it. I like it. I want to ask a final question, which is really about clean energy ventures. What are you excited about the next 18 months?
I mean, that's a good question. So there are a few things. The US economy, because of Citizens United and how messed up our campaign finances, neither party would put in enough regulations to actually force companies to decarbonize. But Europe is actually putting the sticks in place. In the US, we dangle carrots in front of people in the terms of incentives and subsidies. And the reality is to buy these into these lower carbon supply chains, and you have to convince your procurement person to do it. That's a lot of risk, right? And there's no penalty for not decarbonizing. There was some shareholder headwinds, but those don't exist any longer. There's some consumer headwinds or pushback in certain cases. And so if you look at the sort of the 4,500 companies that made, net zero's SBTI targets, they're not buying new technologies that can risk their operations. They've got to be you've got to have a technology that has under a 3-year payback for even a CFO. We call it the paradox of the 12. So the CEOs are measured every 12 weeks. They're compensated every 12 months. The reality is that the average tenure of a CFO and a CEO in corporate America is about 4 years, 5 years. And they're not going to be making 10-year bets, right? In Europe, if they can get these regulations in place and with the right teeth and with very few exceptions, Those are major sticks. I mean, they're saying you basically can't do business with their 600 million consumers that we have in this market. So excited about that, concerned that it's going to be watered down over time. Um, but oddly enough, I'm actually pretty excited about sort of the Trump administration. You know, you can't use words like climate and decarb and yada yada yada. But if you look at what they're focused on supply chain security. They're focused on advanced manufacturing, grid resilience, right? It's basically a lot of industrial carbon. And if you can offer a solution that's better, cheaper, and faster to deploy, the administration is behind it. Now, you don't want to get in the crosshairs of some of the industries that they hate, like wind, particularly offshore wind. But there's a lot of stuff that they are actually supportive of. So we'll see how that
Absolutely. I
goes.
think the overlap between a lot of the decarbonization solutions and energy resilience and avoiding imports of materials you could recycle locally or you don't need with new technology, the overlap is very serious. Temple, it was a pleasure to have you on the podcast. Thank you so much.
Thank you. I really appreciate it.